One of the most essential facts of business is that companies need capital to grow. Retained earnings help fund that growth, and they're easy to calculate. To calculate retained earnings, start with your beginning retained earnings balance. Then add net income and subtract any dividends paid. The result is your ending retained earnings for the period. Retained earnings are the portion of a company's profits that are kept in the business instead of being paid out to shareholders as dividends. Companies use retained earnings to reinvest, pay down debt, or plan for future growth. At the end of each accounting period, a company updates retained earnings by adding net income and subtracting dividends. Over time, this balance shows how much profit the business has reinvested back into itself. You'll find retained earnings on the balance sheet under Shareholders Equity. While they're not an asset, they're a key measure of a company's financial strength. With BILL, you can track expenses, streamline approvals, and keep financial data organized, making it easier to understand profitability and manage retained earnings with confidence.